Most business owners think they have a tax strategy. What they actually have is a list of write-offs. And the advice they keep getting is the same thing on repeat. It's find more stuff to write off, buy more things, spend more money, and reduce the overall number. And look, I get why that advice exists. Deductions are important so that you don't overspend money in your business. But if that's your entire strategy, you're leaving so much money on the table. And I'd argue in some cases, you're actually making your financial situation worse, not better. So in this video, I want to show you why write-offs alone don't work, what's actually happening when you chase them, and what a better approach looks like for a service business owner trying to actually build something. And stick with me through the middle of this video because I'm going to show you the reframe that changes how you think about every dollar in your business going forward. Okay, so first off, let's be clear on what a write-off actually is. When you write something off, you're telling the IRS this was a business expense, so don't count it as taxable income. And as a result, your taxable income, it goes down and your tax bill goes down a little bit. That's it. That's all it does. So if you're making $500,000 in profit and you find $50,000 worth of deductions, now you're only going to get taxed on $450,000. At a 40% combined tax rate, that saves you about $20,000. And look, I'm not going to sit here and say that's not worth it. It still is one part of the strategy. But here's the problem with making that the entire focus. To get a write-off, you have to spend money. And I talk with a lot of business owners who end up spending money that they wouldn't have otherwise spent, purely because someone told them it was worth it for a write-off. It usually looks like this. You spend $30,000 on something you didn't really need, you save $12,000 in taxes, but now you're down $18,000 in real cash and you have nothing to show for it. And in my personal opinion, that's an awful way to run your tax strategy and just overall your business. And this is where you can benefit, because the question that nobody's asking is, what if you took that same money and you actually did something with it? But before I get into that, there's one thing you need to understand about how the tax code works, because most service business owners have never had this explained to them. The IRS doesn't charge the same rate on every dollar that you make. It charges different rates depending on what type of income it is. So in your case watching this, if you run a service business like an agency, consulting, coaching, trades, every dollar you make is earned income. And earned income is the most heavily taxed type of income in the entire tax code. You get federal income tax plus self-employment tax stacked on top of it. And you're often looking at 35 to 45 cents taken from every dollar. Now then you got capital gains income, money from selling investments, real estate, a business stake, that maxes out at 20%, not 40%, 20%. So half of some of the higher tax brackets. And then you got passive income from things like rental properties that comes in even lower than that. So with these two things, you could be making the same amount of money, but because it's a different type of income, it's treated completely different in the tax system. And the problem is every dollar that's left, it's still getting hit at the highest rate. And the people that are paying dramatically less in taxes aren't just focusing on this. They're building other types of income alongside it. But here's the thing. And this is the part that actually matters for where you are right now. You don't need to go buy real estate tomorrow to start saving money on your taxes or building wealth. The highest leverage move for most service business owners that I talk to is a lot simpler than that. Now, here's what actually happens when write-offs become the whole strategy. You end up finding ways to spend money just to spend it. Not because the purchase might make an ROI for the business, but because someone just said it was deductible. And honestly, I've still not yet to see the math that works out in your favor. You spend $50,000 on something at a 40% tax rate, you save $20,000 in taxes, but you're still down $30,000 in real money. And if that purchase doesn't do anything for your business, maybe you bought some random car or some random piece of equipment and it doesn't bring in more revenue, it doesn't make your team more productive, and it doesn't even help you grow the business, then that $30,000 you spent is all gone. You didn't use it to build anything useful for yourself, you just felt better because it saved you on taxes. Now, flip this on the other side. What if that same $50,000 went into something that actually grew your business? Maybe you hire a salesperson and they close $200,000 in new revenue. You put it into paid ads and that returned a 3 to 1x ROI for you. You invest into a system that cuts your team's time in half and lets you take on more clients without adding extra headcount. Now, when you do it that way, that $50,000 is a business expense. So yes, it's still a write-off. And yes, you still do get a tax benefit, but on top of it, you made money. Instead of just putting it into some worthless asset that you might use for for fun, you compounded it into something that gives you more money back. Now, from a tax perspective, the write-off is going to be the same either way, but in one scenario, you're down $30,000 with nothing to show for it, and in the other one, you grew your business and paid less in taxes doing it. That's the whole difference. That's the reframe that I'm trying to get you to understand. And look, it sounds obvious when I say it out loud, but I talk to a lot of business owners every week who are making this exact mistake without even realizing it. So what does this actually look like in practice? It comes down to one question before you spend any money in your business. Is this going to make me more money, or am I just doing it for a write-off? If the answer is you're just doing it for a write-off, it's not worth it because you're spending $1 just to get 40 cents back. That math is never going to be in your favor. But if the answer is yes, and you're actually putting it towards something like a new hire or a marketing system that's going to bring money in, it's going to generate revenue, improve your margins, and make your team more efficient, then I would 100% spend that money to buy that thing. And the tax benefit is just a bonus on top of the smart business decision. That one little reframe is going to change how you look at every dollar in your business. So instead of buying worthless stuff like we talked about, invest that money in marketing that's actually working and scale it up. Hire someone new for the business that's actually going to generate something. That salary is a write-off as well. And if they generate more revenue than they cost you, it paid for itself many times over. And instead of just doing year-end spending just to lower your tax bill, look at what's actually slowing your growth and put the money there. What's the bottleneck? What's actually going to move the needle here? And look, the tax savings, it's always going to follow the smart decision. And you didn't make the decision for the tax savings. When you think about it like this, something else starts to happen. You start building a better business. You actually grow your revenue. Your profit grows as well. And as that happens, you start building real assets in the business, equity in the business, cash reserves, investment capital. And all of those things eventually are going to generate different types of income, like we talked about before, that are going to be taxed at much lower rates than you're paying right now. This is the long game. And I want you to start thinking about this many years down the line. And playing the long game, it just starts with spending lots smarter in your business. But here's the reality for most service business owners that are watching this. Your current tax approach is probably make money, find things to write off, pay the bill, and then repeat. And every year the bill gets bigger as you grow because nobody's actually looked at the bigger picture of how you're deploying the money that your business is making. So I want you to walk away from this video with 3 questions that are worth asking yourself right now. The first one is, when you spend money in your business, are you just doing it because it makes business sense or because someone told you that's where you should be spending your money? The second thing is, do you have a clear picture of what your tax bill is going to look like this year before April happens? And third, is anyone helping you build a plan around your finances, or are you just finding out what you owe when it's too late before you can do anything about it? If the honest answer to any of those is no, that's exactly the gap that we work on with clients. And if you want to know what that looks like for your specific situation, the starting point is a free financial audit. On that audit, we're going to go through your numbers, your tax position, and where the gaps are. And you'll walk away knowing exactly where you're overpaying and what you can do about it. And we'll do it whether you work with us after that or not. If that interests you, the link is going to be in the description. You can fill out a short form and we'll get a call on the calendar. And if you just want to get the full framework on your own first, before you even talk with us, I created a free 75-page financial playbook that covers all of this in detail. It's also in the description. It's completely free. Either way, can we please stop spending money just to get a write-off? There's way better uses of every dollar in your business instead of just blowing it on random things. So I hope you liked this video. If you liked it, subscribe, and I'll see you in the next one.